Welcome to The Explainer. Today we're doing something really fun. We are acting as expert investment analysts and putting a highly talked about biotech company through the absolute ringer. We're talking about Vericel, ticker symbol VCEL. They just dropped a massive Q1 2026 earnings report with a 30% jump in revenue, and let me tell you, the market is buzzing. But here's the real question we need to answer. Do we buy the hype, or do the fundamentals tell a totally different story? Today, we're running Vericel stock through our legendary valuation gauntlet. We're going to apply the rigorous frameworks of Warren Buffett, Benjamin Graham, Peter Lynch, and some hard discounted cash flow modeling to see if this company is actually worth its current price tag.
Okay, let's quickly look at the roadmap for our stress test. We're going to start with a rapid company snapshot, then apply those classic Buffett and Graham lenses. From there, we'll shift gears into the Peter Lynch growth framework, run our own DCF and alternative mathematical models, and finally, synthesize the whole thing for our final verdict.
All right, part one, the company snapshot for Vericel.
Let's establish the baseline hype around this stock right now. Vericel currently trades at around $37 a share, giving it a market cap of roughly $1.89 billion. They're a leader in advanced cell therapies specifically for sports medicine and severe burn care, which is a really fascinating high-tech corner of the healthcare sector. And as you can see, the business is growing fast. Q1 2026 brought in $68.4 million in revenue. That is a massive 30% year-over-year jump compared to Q1 2025. Because of that explosive start, management actually raised their full-year guidance to a range of $326 to $336 million.
Now, what's really interesting is where exactly that cash is coming from. Their flagship product is called MACI. It's an advanced knee cartilage repair therapy, and it makes up the lion's share of their revenue at $56.4 million. That's a very solid 22% growth rate right there. But look at that burn care slice. Driven by products like Vericel and Nexobrid, burn care revenue hit $12 million. That is an absolutely staggering 91% growth rate year over year. The top-line momentum is undeniably there.
Section 2. The Buffett and Graham lenses. So the growth story is great, but what happens when we apply our first rigorous tests? Let's look at Vericel through the highly conservative, value-driven philosophy of Warren Buffett. Ticking through his checklist, first up, an economic moat. Vericel passes this easily. Their proprietary cell therapies, complex manufacturing, and a recent $197 million BARDA award create a massive barrier to entry. Manageable debt? Pass again. Their balance sheet is literally pristine, with zero debt and about $211 million in cash. But here is where it gets tricky. High return on equity? Fail. It's currently sitting at a really low 6.54%, and we know Buffett usually demands 15% or higher. And consistent earnings? Also a fail. They reported a net loss of $6.3 million in Q1. Now, we can calculate their owner earnings, or free cash flow, at a positive $15.1 million for the quarter, but that negative EPS and low ROE mean Buffett would likely pass on buying today. He'd throw this on a watch list until those earnings turn consistently positive.
Next up, the father of value investing himself, Benjamin Graham. Let's run his strict deep value defensive checklist. Adequate size? Pass. A $1.89 billion market cap easily clears his typical $250 million threshold. Strong finances? Pass. Their current ratio is an exceptionally healthy 5.18, meaning they have way more liquid assets than they need to cover short-term liabilities. But again, earning stability is a fail because of that negative 12-cent EPS in Q1. Finally, moderate multiples? Hard fail. Vericel is trading at a sky-high price-to-earnings ratio of nearly 88 and a price-to-book of 5.30. Graham strictly demands a PE below 15 and a PB below 1.5.
To put a finer point on it, let's run the actual math on Graham's famous intrinsic value formula. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. This is his ultimate, definitive test for finding a stock's margin of safety. But here's the catch. Because Vericel currently has a negative earnings per share, Graham's formula mathematically breaks down. You literally cannot take the square root of a negative number. Under Graham's strict deep value framework, the intrinsic value is $0. He simply wouldn't touch a company without positive, stable earnings, no matter how fast those revenues are growing.
Section 3. The Peter Lynch lens.
All right, so the deep value guys are completely out. Let's pivot to a growth-oriented approach. Peter Lynch's growth at a reasonable price, or GARP framework. Given their explosive expansion, Vericel should fare a lot better here.
The first step in Lynch's system is categorization. With 30% overall revenue expansion and incredibly scalable biotech products, Vericel falls squarely into Lynch's favorite bucket, the fast grower. Plus, Lynch loves companies with strong balance sheets, which we already established Vericel has, being completely debt-free.
But remember, Lynch wants growth at a reasonable price. He's not just going to pay whatever the market asks. So we calculate the PEG ratio. To do this, we take their forward PE, which is 71.35, and divide it by the revenue growth rate of 30%. That calculation gives us an estimated PEG ratio of 2.37. Lynch's ideal target is a PEG of exactly 1.0. Furthermore, we don't see any heavy insider buying or noticeably low institutional ownership right now to give us that extra confidence in the valuation. So at $37 a share, it's a hold in Lynch's book. It's just a bit too expensive.
Section 4. The discounted cash flow model. We've seen what the investment gurus think. Now let's pivot from those qualitative theories to some hard mathematical valuation using a DCF model. This tells us what the company's future cash flows are actually worth in today's dollars. Here are the steps, and I'll explicitly state our assumptions to fill in the gaps here. First, we forecast free cash flow. Vericel generated $15.1 million in Q1, so I'm assuming we annualize that to a base of roughly $60 million, and we'll grow it from there over a 5-year forecast period. Second, we estimate the terminal value using an industry average 3% perpetual growth rate. Finally, we discount those future cash flows back to the present value. Since biotech is inherently a risky sector, we're assuming a standard biotech weighted average cost of capital, or WACC, of 10%.
Running those exact assumptions through the model gives us a base case fair value of $28.50 per share. Notice the gap? Even with generous growth assumptions built into our free cash flow projections, the intrinsic mathematical value simply trails the current $37 market price. And this brilliantly illustrates exactly why we run a sensitivity analysis. Valuation isn't just one magic number, it's a range based on our assumptions. Look at the middle row, our 10% WACC base case. It tops out at $31.90, even if we assume a very optimistic 4% terminal growth. You only reach the current $37 share price if you assume an aggressively low 8% cost of capital alongside robust perpetual growth, meaning at current prices, there's zero margin of safety for the investor.
Section 5. Alternative Valuation Models.
So the DCF suggests it's overvalued. Let's quickly check the pulse of the broader market using alternative comparable multiple models to see if there's an angle we somehow missed. But honestly, the market multiples tell a very clear story too. Vericel's numbers are sky high across the board. An enterprise value to EBITDA ratio of almost 66, a price to earnings of nearly 88. Compare that against traditional value benchmarks where an EV to EBITDA under 10 or a PE under 15 is considered fair. This highlights the absolute massive premium the market is currently paying for Vericel's growth. Investors are literally pricing in years of flawless execution right now.
Section 6. The Synthesis and Final Verdict.
We have officially run the gauntlet. We've looked at the qualitative moats, the deep value metrics, the growth pricing, and the discounted cash flows. Here is our final scorecard. The strengths are absolutely obvious. Zero debt, a pristine balance sheet, strong free cash flow generation, and explosive 30% top-line growth. But every single rigorous framework we applied suggests caution. Graham is a hard sell because of the negative EPS. Buffett is a hold or watch until ROE and earnings stabilize. Lynch says it's a fast grower, sure, but a hold because a PEG ratio over 2 is just too high. And our DCF model gives us a base case of $28.50. So to trigger a buy, we need to see the price come down closer to that high 20s mark or see earnings positively explode to compress those multiples.
This leaves us with our final thought for the explainer. Vericel is undoubtedly an incredible business doing groundbreaking work in biotech, but a great company doesn't always equal a great stock at any given price. So, is Vericel a fundamentally sound investment at $37.03, or is it just riding the hype of a 30% revenue jump? Based on our gauntlet, value logic firmly suggests waiting for a pullback to the high 20s before stepping in. You have to weigh that incredible biotech growth against the strict demands of value investing and decide what kind of investor you want to be. Thanks for joining me on this deep dive, and as always, keep your pencils sharp.